Hello, Explorer friends. On March 12, 2026, I'll introduce Philip Morris International Inc., the friend that moved plus 3.9%. Hello, Explorer friends. Today's company is Philip Morris International Inc. The reference date is today, and the stock moved 3.9% today. Hello, my Stock Explorer friends. Today we're diving into Philip Morris International, which jumped 3.9% in today's trading. Before we get into why the stock moved, let's understand what this company actually does and why it matters in the market. Let me share today's numbers first. Philip Morris International climbed 3.9% with 5.5 million shares traded, slightly below its three-month average of 5.6 million. Over the past 5 trading days, the stock has gained 1.19%, showing steady momentum. The company holds the #1 position in the tobacco industry within the consumer defensive sector. Now, what does Philip Morris International actually do? At its core, this is a tobacco company that sells cigarettes and other tobacco products to consumers around the world. Think of it as a global manufacturer and distributor of one of the world's most regulated consumer products. The international in its name is key here. This company operates outside the United States, serving smokers in over 180 countries and territories. The tobacco business might seem straightforward, but it's actually quite complex. Philip Morris doesn't just make cigarettes and hope people buy them. The company manages massive supply chains that start with tobacco farmers, run through sophisticated manufacturing facilities, and end at millions of retail points worldwide. It's like running a global logistics network, but for a product that faces unique regulatory challenges in every single market. Each country has different rules about packaging, advertising, taxation, and where cigarettes can be sold, making this a regulatory maze that requires local expertise everywhere. What really sets Philip Morris apart is its brand portfolio. Marlboro, the company's flagship brand, is like the Coca-Cola of cigarettes, instantly recognizable and commanding premium prices worldwide. When you control a brand that smokers actively seek out, you gain pricing power that most consumer companies only dream about. Beyond Marlboro, the company owns a collection of international and local brands that cater to different price points and taste preferences. This brand architecture is like having multiple fishing lines in the water. If one market segment struggles, others can compensate. The manufacturing side reveals another layer of competitive advantage. Philip Morris operates some of the most advanced tobacco processing facilities in the world. These aren't just factories rolling cigarettes. They're precision operations that blend different tobacco types to create consistent flavor profiles across billions of units. Imagine trying to make every cup of coffee taste exactly the same across 180 countries, and you'll understand the complexity. This manufacturing excellence creates barriers to entry that protect market share. So where does the money actually come from? The primary revenue driver is simple. Consumers buy cigarettes and other tobacco products at retail stores, and Philip Morris gets paid by the distributors and retailers who stock their products. Every pack of Marlboro sold outside the US, for example, puts money in Philip Morris's pocket. The company typically sells to wholesalers and large retail chains, who then distribute to smaller shops and convenience stores where consumers make their purchases. But the revenue model goes deeper than just selling cigarettes. Philip Morris has mastered the art of price optimization, gradually increasing prices faster than volumes decline. It's like a delicate dance where you raise prices just enough to grow revenue without pushing too many customers away. This pricing power comes from brand strength and the addictive nature of nicotine. When your customers are physically dependent on your product, demand becomes remarkably inelastic. What makes this business model particularly interesting is its predictability. Tobacco users tend to be extremely loyal to their brands and purchase regularly. This creates what investors call a defensive business, one that generates steady cash flow even during economic downturns. When times get tough, smokers might skip the fancy coffee or cancel their gym membership, but they usually keep buying cigarettes. This recession-resistant quality makes tobacco stocks behave more like utilities than typical consumer companies. The second revenue axis likely comes from geographic diversification. While the current information doesn't break down specific regional revenues, operating internationally means Philip Morris can balance slower growth in developed markets with expansion in emerging economies. In some countries, smoking rates are declining, while in others, a growing middle class means more potential customers. This geographic spread helps cushion the company from regulatory shocks in any single market. Consider how this geographic strategy works in practice. In Western Europe, smoking rates have been falling for decades, but Philip Morris maintains profitability through premium pricing and cost management. Meanwhile, in parts of Asia and Africa, rising incomes create new middle-class consumers who often view international cigarette brands as status symbols. It's like having a portfolio of markets at different life stages, mature ones generating cash and growing ones providing expansion opportunities. The company's distribution network represents another crucial competitive moat. Building relationships with thousands of wholesalers and retailers across 180 countries takes decades. These aren't just business transactions, they're partnerships built on trust, credit terms, and mutual dependence. A new competitor can't simply show up and access these channels. It's like trying to replicate Amazon's delivery network overnight. theoretically possible but practically impossible without massive time and investment. But here's where things get interesting for investors. The tobacco industry faces a fundamental challenge. Smoking rates are declining in many developed countries due to health awareness and regulatory pressure. So, how does a tobacco company grow when its core product faces headwinds? This is the transformation question that Philip Morris and its peers must answer. The company's response to this challenge involves a strategic pivot toward what the industry calls reduced-risk products. These include heated tobacco devices and other alternatives that deliver nicotine without combustion. Think of it as the difference between grilling and frying. Both cook your food, but one produces less smoke. Philip Morris has invested billions in developing these products, betting that smokers will switch to potentially less harmful alternatives while still delivering nicotine and profits to the company. This transformation strategy isn't just about product development, it's about reimagining the entire business model. Traditional cigarettes are simple: manufacture, ship, sell. But heated tobacco devices require educating consumers, providing ongoing support, selling replacement parts, and creating an ecosystem of accessories. It's like moving from selling hammers to selling smartphones. Suddenly you need apps, updates, and customer service. This complexity creates both challenges and opportunities for companies willing to invest in the transition. Now, let's talk about why the stock jumped 3.9% today. The primary driver appears to be related to shareholder returns. While the specific announcement details aren't provided in today's information, tobacco companies are known for their generous dividends and share buyback programs. When a company like Philip Morris signals enhanced returns to shareholders, the stock often responds positively. The second reason connects to the trading pattern itself. Today's move happened on slightly below average volume, with 5 million shares compared to the typical 5 to 6 million. This suggests the buying was selective rather than a broad market rush. It's like a focused group of investors making deliberate purchases rather than everyone piling in at once. This type of move often indicates institutional investors or value-focused buyers taking positions. The third factor relates to the broader conversation around tobacco stocks in the investment community. Recent market commentary has highlighted tobacco companies as potential opportunities, particularly in discussions about ESG investing and defensive positioning. While these articles represent market interpretation rather than confirmed facts, they can influence investor sentiment and create momentum. Let me explain why shareholder returns matter so much for a tobacco company. When a business faces long-term decline in its core market, returning cash to shareholders becomes crucial. It's like a mature tree that stopped growing taller but still produces fruit. Investors want to harvest that fruit regularly. Tobacco companies generate enormous cash flows, and when they commit to sharing more of that cash through dividends or buybacks, it directly benefits shareholders. The cash generation capability of Philip Morris is truly remarkable. Cigarettes have minimal production costs compared to their selling price, creating profit margins that make tech companies jealous. This cash flow reliability allows the company to make long-term commitments to shareholders. When Philip Morris announces dividend plans, investors can generally count on them being fulfilled, unlike growth companies that might need to reinvest every dollar. So what should we watch going forward? First, understanding Philip Morris's actual revenue mix between traditional cigarettes and next-generation products would clarify whether this is purely a declining legacy business or a transformation story. Many tobacco companies are investing heavily in alternatives like heated tobacco or nicotine pouches. If Philip Morris shows progress in these areas, it could change the long-term narrative. Second, pay attention to how the market treats Philip Morris relative to other consumer defensive stocks. While it's classified in this defensive sector, tobacco faces unique risks that companies selling soap or cereal don't encounter. Regulatory changes, excise tax increases, or smoking bans can dramatically impact the business model. These risks make tobacco stocks behave differently from typical defensive names. Third, watch for more concrete information about the shareholder return initiatives. Today's move suggests something positive, but without specific details about dividend increases or buyback authorizations, we're working with incomplete information. When companies provide actual numbers, like a 5% dividend increase or a $2 billion buyback program, investors can better evaluate whether the stock move was justified. Now, let's discuss the risks. First, today's sharp 3.9% gain could easily reverse tomorrow. When a stock jumps on below average volume, it often means there wasn't broad conviction behind the move. Fast money traders who bought today might take profits quickly, especially if no additional positive news emerges. It's like a small group pushing the price up. If they step back, the support disappears. Second, we're working with limited financial information about Philip Morris. The current data doesn't include key metrics like revenue growth, profit margins, or valuation multiples. Without these fundamentals, it's hard to judge whether today's price accurately reflects the business reality. Investors should seek out the company's actual financial reports before making decisions. Third, the tobacco industry faces existential long-term risks that today's price action doesn't address. Declining smoking rates in developed markets, increasing regulatory pressure, and growing ESG concerns create ongoing headwinds. While Philip Morris might successfully navigate these challenges, they represent real threats to the business model that go beyond normal market volatility. What makes Philip Morris particularly interesting from an investment perspective is this tension between its current cash generation and future challenges. The company essentially prints money today. Tobacco is one of the highest margin consumer products in existence, but that cash comes from a product facing secular decline. It's like owning an incredibly profitable coal mine in an era moving toward renewable energy. The profits are real today, but the future requires careful navigation. For investors considering tobacco stocks, the key question becomes one of time horizon and values alignment. In the near term, companies like Philip Morris can deliver attractive returns through dividends and buybacks. The cash flows are real and substantial. But longer term, the business model faces questions that even the best management teams struggle to answer definitively. The international scope adds another layer of complexity. While smoking declines in places like Europe and Australia, other markets still show growth. This geographic arbitrage can extend the runway for traditional tobacco products, but it's not a permanent solution. Eventually, global health trends catch up everywhere. The regulatory landscape deserves special attention. Every country treats tobacco differently, from plain packaging requirements in Australia to advertising bans in the European Union. Philip Morris must navigate this patchwork of rules while maintaining profitability. It's like playing chess on multiple boards simultaneously. Each move in one market might trigger responses in others. This regulatory complexity creates both risks and competitive advantages for established players. Understanding Philip Morris International means recognizing it as both a cash flow machine and a business in transition. The company knows its traditional product faces challenges, which is why shareholder returns become so important. When growth becomes difficult, returning cash to owners becomes the primary way to reward investors. The investment case ultimately depends on your perspective on managed decline versus transformation. If you believe Philip Morris can successfully transition to reduced risk products while maintaining its cash generation, the stock offers an interesting opportunity. If you think the traditional tobacco business will decline faster than alternatives can grow, then today's pop might be a selling opportunity rather than a buying signal. As we wrap up today's exploration, remember that Philip Morris International's 3.9% jump reflects more than just daily market noise. It represents ongoing investor interest in a complex company navigating between profitable legacy products and an uncertain future. Whether today's buyers are right depends on your view of how successfully tobacco companies can manage their transformation while maintaining those famous cash flows. Keep watching for concrete news about dividend policies, buyback programs, and especially any updates on next-generation products. These will tell us whether Philip Morris is simply managing decline profitably or actually building a bridge to a post-cigarette future. Until then, treat today's move as an interesting data point in a much longer story. Thanks for joining today's exploration of Philip Morris International. Tomorrow brings new market stories, and we'll be here to help you understand not just the price moves, but the businesses behind them. Until then, keep learning and stay curious. One last reminder, this is not a magic spell that makes the investment decision for you. The job here is to introduce the company well and interpret today's move without forcing it. If the evidence is thin, we should say it is thin, and if more study is needed, we should leave that as the next assignment. We spend more time on the company than on the one-day move because understanding the business comes first. When you understand the company, later headlines become much easier to read without exaggeration. Let's check another company together tomorrow. See you. 왜올랐주!